Good morning, everyone. Welcome to our webinar on the SEC regs and other topics related to climate. Excuse me. My name is Tensie Whelan. I'm a professor at NYU Stern, and I'm the founding director of the Center for Sustainable Business. And I think, really important for us to be discussing the new regulations, both primarily here in the US, but also a bit to talk about what's happening in Europe and elsewhere, because we are seeing the increasing impacts of climate. Last year, we saw that climate rose about 1.2 degrees, but in many parts of the world, we were at that 1.5 degrees that we know drives significant negative environmental and social and economic impacts. In fact, Swiss Re has determined that the total costs of climate change may run to, I think it's 23 trillion or more. And Swiss Re also came out with a recent study that showed that the US and the United States and the Philippines are the countries most affected economically by climate change, with huge impacts on business and on investments, which is why the SEC regulations are so interesting in terms of potentially giving investors and others insight into the climate risks to which corporates are exposed. We at the Center for Sustainable Business look a lot at how we can drive better sustainability performance by companies that will reduce risk, but also create business opportunities. And in a time like this, when we all personally are feeling the effects of climate change, and when our corporations are feeling the effects, but also in some cases driving those negative impacts, there's a huge opportunity to make a difference together and improve the environment for us and our kids. So look, really glad to bring to you today two fascinating speakers, well-versed in the topics of climate change and of these regulations. We have, and I'll invite them to join me on our virtual stage here, Valerie Wieman, who is partner at PwC. And PwC, as you might imagine, has been tracking these regulations quite carefully. And also Steven Rothstein, who is managing director of the Accelerator for Capital Markets at Ceres. And Ceres has been also quite active working with investors and corporates, but particularly with investors around understanding and managing climate risk and lobbying for better regulations that will protect investors and others. So delighted to welcome you both. Our format today for our audience is we will hear from Valerie first, who will summarize where we are on the regulation. Then we'll hear from Steven with his insights on where things are going. And then I'll ask a few questions, and then we'll open it up to the broader Q&A. I want to point out to you that we have at the bottom of your screen, I'm sure all of you are used to this by now, there is a Q&A icon. Please feel free throughout the talk to answer, to put in your questions. We'll be monitoring it. And then we will also be pulling out some of them to answer later in the session. The full session will take no more than an hour, so we'll send you on your way after that. So let me invite Steven and myself. We'll take ourselves off camera. We're going to turn it over to Valerie to kick us off. So thank you again, both of you, for being here with us.
Great, thanks so much. Let me just take a moment to share my screen here. And have that pop up. There we go. So pleasure to be here. Thanks so much. I will take you through the SEC's recent release, so coming out on March 6th. These SEC rules were long anticipated. They were originally proposed in March of 2022, so it was almost a full 2-year process in having that resolved from going through the responses to that original proposal. The SEC received, by their count, over 16,000 comments on the original proposal, and there were some significant changes from what was proposed to what was finally seen in the rules. Where we got here was also a much longer story. There was a year earlier when then Acting Chair Alison Heron-Lee originally asked for input on what disclosures should be made by corporates relative to climate change. But even before that, it's probably a 50-year process when the SEC started looking at requiring disclosures about environmental litigation. And most significantly in 2010, they issued some interpretive guidance that tried to explain how current SEC rules would elicit or be reasonably expected to elicit information about climate change, culminating in these rules, which are significantly more prescriptive. Now, Tensie mentioned that this is another entrance into the regulatory landscape. There are obviously some significant rules abroad. The big three, so to speak, that people refer to are the SEC, the standards from the International Sustainability Standards Board, which is the sister entity to the IASB, as well as the European Sustainability Reporting Standards that were issued to enact the Corporate Sustainability Reporting Directive, or the CSRD, in the European Union. Now, the SEC is specifically focused on the needs of investors. That's part of their three-part mandate. So this is intended to provide information to investors that is decision useful in their investment decisions. And that is really the basis for a lot of these disclosures. And that was one of the changes from the proposal, is that there is a materiality assessment for a number of these rules. And that materiality is based on the needs of investors. That's a standard definition that's long been used by the SEC. It's based on the securities law definition. It's based on Supreme Court precedent, and really talks to materiality being the assessment of information that is useful for investors, or that changes the total mix of information provided to investors in order to make decisions. Now, the SEC rules, like the ISSB and the CSRD, are based on a foundation of the recommendations of the Task Force for Climate-Related Financial Disclosures, or the TCFD framework. There were a lot of companies who were voluntarily reporting under the TCFD framework. Now, the TCFD framework has 4 pillars, and you'll see them here because they are represented very specifically within the SEC rules. You have governance, strategy, risk management, and targets and goals. Within the governance element, this is getting at the oversight about how risks are, climate-related risks specifically, are identified, prioritized, and managed. And there are disclosures required both of management's role in how they assess and manage those risks, as well as from a board of directors oversight. That's important. There's a very strong tendency in these regulations to ensure and to specifically make the oversight of these risks the responsibility of the board. There was some change relative to the proposal. The original plan was, or in the proposal, that you would need to identify whether you had a member of the board of directors with climate-related risk expertise. That's no longer required. The disclosures are a little bit more generic about the oversight of the board. And that's important because in the responses to the proposal, there was some concern that by requiring a company to disclose whether a board member had expertise, companies would feel inclined or pressured to add a director with that expertise, which some thought would take the make versus buy element away from the board, meaning that they are perfectly capable of leveraging experts as opposed to having them in-house on the board. From a strategy standpoint, this is really the core of the requirements for these climate-related risks. So companies would be required to disclose the climate-related risks that have materially impacted or reasonably expected to impact their financial performance and their strategy. Those risks would need to be separated by physical and transition. So physical can be either acute or chronic. Acute risks would be one-off items, a flood, a hurricane, could be a specific wildfire. And the chronic risks would be longer term: sea level rise, changes in salination, flood zones, or drought. And in some cases as well, here's where the judgment comes in. You could look at wildfires as a chronic condition as well. Transition risks are more related to how a company is adapting to a low carbon economy. And those transition risks would need to be identified as whether they relate to regulatory, technological requirements, and the sort of the changes in the environment. Now, those risks need to be identified over the short and the long term. Now, this is also a difference from the proposal. as well as a difference from the other international frameworks who require short, medium, and long-term. The SEC determined that medium was basically an arbitrary classification. So they obviously not changing the types of risks, but only the classification into 2 buckets versus 3. The short term is 12 months, so consistent generally with how short term is evaluated for financial reporting purposes, and the long term is the period beyond that. There's also a requirement to disclose transition plans that are used to manage transition risks, as well as your scenario analysis and internal carbon pricing. Scenario analysis is only required. This again was some question relative to the original proposal that seemed to require an expansive use of scenario analysis. Scenario analysis is only required if it is used. It's not required to be used. And if the use of scenario analysis identifies a material climate-related risk. So it's sort of a 2-prong assessment as to whether you would need to disclose your use of scenario analysis. Now, if you are required to have a disclosure of scenario analysis, you need to identify the scenarios that were used and what the impact would be of each of those scenarios. On the risk management side, this is again focused relative to process, so it's related to management's role of governance and how they identify, assess, manage, and prioritize those risks, as well as whether the assessment or the consideration of climate-related risks are integrated into how the company overall assesses the risk to the organization. And from a targets and goals standpoint, targets would be required to the extent that they have a material impact on the financial statements. So you're not required to have an emission reduction or other climate-related goal, but you do need to disclose it if you have one. And in addition, on an annual basis, you would need to update these disclosures as far as your progress toward meeting the goal. And that's generally looked at as an anti-greenwashing, so a little more transparency into companies who claim to be making progress or claim to be net zero, and a little more transparency into their consideration and their progress toward those stated goals. The other significant change relates to the disclosure of greenhouse gas or GHG emissions. So these, again, are disclosures outside of the financial statements. And companies would be required to disclose their Scope 1 and Scope 2 emissions. Now here, it's not all companies, it's only your largest registrants. It would be applicable to your large accelerated filers and your accelerated filers. So the 2 largest classes of registrants for the SEC according to their rules. Now, those Scope 1 and 2 emissions would only need to be disclosed if they are material. Scope 3, and maybe I'll just back up a second with regard to Scope 1 being a company's direct emissions, Scope 2 being the emissions generated by purchased heating, cooling, ventilation. Your Scope 3 was highly contentious in the proposal and related to the upstream and downstream value chain. So going from back through your suppliers down through the users of your products. That was eliminated from the proposal. And as I said, that was highly contentious. So that was definitely a step that was made to make the rules more palatable and we believe to get a little more support from the commission itself. The disclosure allows a little bit more flexibility than the proposal. Originally, it was mapped pretty consistently to the greenhouse gas protocol. The final rule allows a little more flexibility in choosing the framework that's applied with transparency and disclosure about the framework and the assumptions that are used. Those emissions will be subject to third-party assurance. So the Scope 1 and Scope 2 emissions for a large accelerated filer would be subject to initially limited assurance, and that's basically like a review, and then progress to reasonable assurance, or basically an audit. Accelerated filers, which is that next class or the next largest size of companies, they would be required to have limited assurance, again, that review element, but currently there's no plan for them to progress to reasonable assurance. So they would stay at the review level and not be required to obtain an audit from a third party of those emissions. Now, different than the international frameworks, the SEC is the only one to actually touch the footnotes of the financial statements. So the rules modify Regulation SX, which governs the contents of the financial statements themselves. Here, they're not talking about climate. The important differentiation is that they're talking about the impact of severe weather and other natural conditions. So they are jumping through those who may have questions about whether climate change is the driver of severe weather and merely asking for the disclosure of severe weather itself. And there's a lot of judgment involved in determining what severe weather is. Now, for these, the threshold for reporting of these amounts in the proposal was 1% of any individual financial statement line item. That is no longer the case. The thresholds sound a lot better. So from a capitalized cost and charges, so think of that as your balance sheet element, those would need to be reported if they are in the aggregate greater than the absolute value of stockholders' equity. For expenses incurred and losses, so think of those as the items that impact your income statement, those would need to be reported if in aggregate they exceed 1% of pre-tax income, subject both of these to a de minimis threshold. Now, while that sounds a lot better, in some cases, if you had an item that would affect operating expenses, for example, that would be 1% of that line item is going to be actually higher than 1% of pre-tax. So in some cases, this could actually require disclosure of more items than they originally proposed. In addition, there are some footnote disclosures about carbon offsets and your renewable energy credits. That's more about the financial impact, so the costs incurred in purchasing carbon offsets. And there are also some qualitative disclosures about how these weather events impact your financial estimates and assumptions, and how they're impacted by severe weather and your disclosed targets. Lastly, I just want to touch on from a timing standpoint. So these are the classes of registrant type. So beginning with your large accelerate filer, they would need to begin their disclosures, excuse me, in fiscal years beginning in 2025. So that would be your 2025 10K filed in 2026, with an additional year for accelerate filers. Your scope emissions would be on a delayed basis. So instead of 25, those would be reported for 26. And your accelerate filers in 28. Excuse me. The middle column for those SK items 1502, those are some specific quantitative impact of climate-related risk on your estimates and your targets. Because they are qualitative in nature, there is an additional year to be reported for those. And as I said, you'll see that the limited assurance and the reasonable assurance are phased in as well. With that, Tensie, I think I'll turn it back to you.
Wonderful. Thank you so much, Valerie. Really helpful, quick overview and understanding this. And we're going to come back to you with questions later. So thank you again for that. Steven, looking forward to turning this over to you now.
Great. Thank you, Tensie. Valerie, that was very informative. And Tensie, thank you to what you do and all the students and all the school there. So I'm going to just, oops, that didn't work. I'm going to try this again. Sorry about that. Sorry, I'm having a little issue with presenting right now. Hopefully you guys can still hear me. Yep.
Yeah,
Okay.
Still hearing you, no problem.
Ceres, while I'm loading this, let me just briefly say, Ceres has been working on this for 20 years. Our first meeting, shoot, the slides are not coming up. Yeah, that would be great, Allison, if you can. Thanks. For 20 years, and the basic idea is that climate is a financial risk. That, as Valerie said, the SEC for the last 91 years has been working on trying to provide the information that investors want. And this is not a new issue, that the SEC's first ruling that mentioned climate was in the 70s. We've met with them again 20 years ago. And that in 2010, they issued a climate disclosure guidelines, not a requirement, but a guideline. And since then, as Tensie said, that the problems have gotten so much worse, that climate risk is financial risk. I'll just give you two quick examples in addition to the Swiss rerun that Swiss Re example that was given earlier. If your company buys, thank you so much, products or services that go through the Panama Canal. Well, because of the drought, there's 40% less ships going through the Panama Canal now. So that increases the chance of a part or a piece of your equipment that could be late, not be able to make shipments. We all remember during the pandemic that from at one point it was diapers, another point it was computer chips, other things got delayed. The other thing is just the major storms. The federal government, NOAA, records those. In the 80s, we had a $1 billion plus storm every 4 months. Last year, it was almost a little more than every 2 weeks. So the chances of whether it be your company or one of your major suppliers or key customer base could be impacted. Last year, according to the Census Bureau, 2.5 million people in the United States, not around the world, but just in the United States alone, were forced to migrate because of climate. So it's clear that because of weather and other natural events, that it is having a bigger financial impact. Investors are wanting it. Also, if you look at shareholder resolutions, you'll see a bigger impact. Next slide, please. Thank you so much, Allison. Appreciate it. That investors are clear. These are just a few of literally, there were 320 institutional investors that wrote to the SEC saying they want climate disclosure, and were overwhelmingly supportive of the proposed rule. And as Valerie did a great job explaining, this final rule is less robust than the final rule, but still has a lot of good provisions. We think it's, again, a lot of excellent provisions there. So that these, and again, why are they doing it? They're not doing it for, despite what some people say now, for any political agenda. They're doing it because it makes good fiduciary sense. If you're managing investments for people over the long term, not just the next quarter, but sometimes the next quarter century, that you have to think about what are the impacts, because we've all seen fires, floods, tornadoes, and other things, the impacts they have. So that this is a real direct impact. And this is also, next slide, please. You'll see that while what the SEC has done is great, the US is behind what's happening around the world. Climate disclosure, has been around for many years in some countries, France 2016 and others. Several countries have been doing parts of their economy over time. Then through the International Sustainability Standards Board, they came out with a model rule, very similar, but more comprehensive than the SEC. Theirs came out almost a year ago. There are now 15 countries in various stages of approval, from Canada and Europe and Asia and many other places, so that it is expected that more and more countries are going to be doing that, just like there are similar rules for accounting in most countries, again, not all. And so that large US companies, even if the SEC didn't act, they still would have to follow disclosure rules. And some have been doing it now for several years because of these international standards. And again, why is that? Because international investors, whether they be the investors that are based here or in Asia or Europe, they want to understand this. And it is very important. Next slide, please. And as important, I won't go through all of these acronyms. Valerie talked about some of them. I do want to briefly just mention about California. Last October, the legislature approved and the governor signed 2 bills referred to as SB 253 and 261 that again require climate disclosure. Very similar, based on what Valerie's talking about, TCFD, the Task Force for Climate-Related Disclosures, one, and Greenhouse Gas Protocol. So there's a lot of common elements with the SEC. One of the interesting things about the California is that it covers public and private companies, because it's focused on how large the companies are. One law refers to companies that are $1 billion or more in revenue. The other one of $500 million. So it's public and private. And the second is, it doesn't matter whether they're just based in California. So they could be based in any place, but have doing business in California. So in some ways, it's really a national legislation, and there's a lot of complementary, which happy to answer more if there is. And then the other area is CSRD in Europe, which goes a lot further. I'll give you just one example how it goes further. In the SEC in the US, it's focusing on the weather impact, the financial impact on the company, because that's what the investor's thinking about. In CSRD, it also, in addition to that, also looks at the company's responsibility on climate. So it's called double materiality. It goes both ways. Go from there. Next slide, please. So, in some respects, the ball game's over in the sense after 2 years of comments, an extra year, as Valerie said, because of the prior request for comments. There were lots of comments, more comments than anything else than in SEC's history, but there are next steps. I mean, there is now a discussion in Congress whether they're going to support this. There are 9 lawsuits. They've all been consolidated into one case. So if it's something that you think is worth supporting, we encourage you to speak out, contact your lawmakers, think about getting involved, being a friend of the court. And for those of you who are representing companies, the question is, if depending where you are, if you're doing scope 1 and scope 2 already, we encourage you to do scope 3. Again, California will require it, the international groups will require it, investors will want it. So the fact that it is not required by the SEC doesn't mean it's not material in many cases. So we'd love to, and Ceres is happy to work with you on any of these areas. Next slide, please. So there we have, when this goes out, you'll be able to get to the links. We have message guidance. We talked about that, and feel free to reach out to me or Randy. I'll put my email in the chat, and talk to your colleagues or trades. There are many folks who feel, again, this is a compromise. We think it's a reasonable compromise. We wish they'd gone further, but a reasonable compromise, and go from there. Next slide, please. So, and there's a lot of information here. We're doing a follow-up next week, and feel free to join us if you'd like more information. So with that, the slides can come down. Tensie, back to you.
Wonderful. Thank you so much, Stephen. I really appreciate you giving us those sets of insights into the kind of global environment and where things are. Let me ask Valerie to come back up, and we'll have a conversation based on both the Q&A from got a really robust set of questions going on. Just a couple questions I'm going to take the prerogative of being the moderator to ask first, and then I will open it up to these other sets of questions. So let's just talk about these lawsuits, right? So you mentioned there's quite a few of them have been consolidated into one. What do you think? I know this is a crystal ball question, but how likely is it to succeed? What do you think the timing might be? And what would be your advice to people to, about this in terms of like, is this all on hold? What do I do about it in the meantime, et cetera? So let me start with you, Valerie.
Sure. So we expected there to be lawsuits. There was some thought that the extended time between the proposal and the final rules were an effort to make it slightly, litigation proof, or to make sure that they had addressed certain components. Some of you may be familiar with a prior SEC rule where it was vacated because the thought was that the SEC had not appropriately responded to some of the charges that was on a clawback provision, in that case was brought by the Chamber of Commerce. So I think that there was an element of trying to make sure that they adequately considered the feedback that they had received in those 16,000 comment letters. The cases also relate to the First Amendment. So basically whether it is compelled speech, meaning that the regulations were forcing companies to say what they think about climate change. There were also some challenges based on the mandate of the SEC and whether they had overreached in establishing these rules. Now, originally, the Fifth Circuit Court of Appeals had put an administrative stay on the rules, which was interesting because that would prevent the rules from being enforced, even though they were not currently enforceable or even enacted or being applied by any individual company. When all the cases were consolidated and assigned to the Eighth Circuit Court of Appeals, the Fifth Court actually lifted its administrative stay, so there's no longer an administrative stay. there is still the litigation. Now, that could take up to a year to resolve. And we're not sure where that comes out, because it's likely that regardless of what the decision is in the Court of Appeals, that both parties would appeal it to the US Supreme Court, in which case you'll need to wait for final resolution at that point. So in the meantime, our best advice is that there is no certainty, and you clearly do not want to be caught unprepared to the extent that the rules are full force on the timeline that's established in the rules. So our best advice for companies is to stay the course, to prepare, and to assume that they will need to comply with the dates as they're listed in the regulations.
Thank you. Stephen, anything you want to add to that?
Yeah, first, I'm not a lawyer, so I don't want to give legal advice, but I completely agree that people should be getting ready. That because of the rule is a compromise, it is more that they thought through in a very thoughtful way, the legal issues, the precedent issues. There are extensive research about the power of and the authority of the SEC. So our assumption is when you get through it all, this will stand. But, we live in a very polarized world, and courts and elections matter. So there's a lot to do. But whether the SEC would have moved forward either way, again, because the international, because the SEC, because of California, the most important thing for companies are to get ready.
Yeah, and I would just add to both of your comments that, with the CSRD, the California regs, other international regs, and your investors asking for this regardless, you need to do it. But I would say beyond that, it'll be part of any well-managed company's set of tools and skills moving forward, because climate change is affecting all of us. That is not going to go away. It's going to get exacerbated. All right, so let me ask another question. One, in looking at the rules, one of the things that concerns me is whether or not there's any sort of perverse incentives built in here. In other words, if companies are only going to be held to account for their goals and targets if they set goals and targets, does that dissuade them from setting goals and targets? Or if they're going to be held to account if they've done a scenario analysis that identifies risk, but they don't have to do the scenario analysis, are they going to avoid doing the scenario analysis so they don't be held accountable for not managing that risk, right? So I would love to get your feedback on that, and open it up to either of you who feels they'd like to respond to that.
Yeah, I'm happy to jump in first and turn over to my colleague. I think in the very short term, it might have an impact, but not in the medium term. Meaning, might a company, this year will affect it, but the reality is they need to do it from planning. Their competitors are going to do it. Their investors are wanting it. Their other regulators are wanting it. So no, we don't think in the long run it will be a deterrent. And in fact, we think it makes a lot of sense. And based on, again, the legal authority of the SEC, that the SEC is a disclosure agency. They're not an environmental agency. They've never been. So they can't tell a company what to do. They can say, once you've made a key decision, disclose it to investors. So we think it is a proper, makes sense. And again, it may affect whether you do it over 1 year, but not in the medium term.
Thanks.
I agree with that. I think, and I started to type that in one of the questions that someone submitted, in that when you look at the CSRD is as much about trying to change corporate behavior. So I agree with Steve when he says the SEC is not an environmental organization. So I think that requiring a company to have a target or goal would be more toward the environmental focus, similar to the CSRD, but even the CSRD doesn't require you to have a goal. So I do think that there are some companies who would shy away from making new disclosures, but they've made disclosures in the past for other reasons, not related to SEC reporting requirements, because either, to Steve's point, they're competitors or in other territories, or because it's fundamental to the corporate culture of how they want to portray themselves. So I just think it would be very short-sighted to change all of that in favor of not putting something in a disclosure. As well as if you have, the only thing you need to disclose is if you have a goal and your progress toward it. So, on one element, you say, well, what are you afraid of? That it is intended to provide transparency to avoid greenwashing, so that you're not making claims or baseless claims that you're not making progress to because of sort of that marketing or the impression of the organization. So I think it would be short-sighted to change your corporate behavior as a result of transparency that only requires you to disclose what you're actually doing.
Great. Thank you very much. Very helpful. So one, I saw this in the chat too, and I had a question as well. So defining extreme weather, right? And you mentioned earlier, Valerie, that the definition is not entirely clear. So how do companies navigate that as they're trying to think about complying with the regulation? But also, I mean, honestly, that is about as well future-proofing your company. So it's something that companies would need to begin to understand anyway. So do you have a set of tools, approaches to help that you recommend to companies to help them navigate that? Now let's start with you, Valerie.
This is going to be a lot of judgment. And we, as in a lot of the thought leadership that we do, we're a bunch of grammar nerds at heart. So sometimes we have these discussions about whether the SEC meant severe weather events or severe weather events. So basically, for want of a comma, to determine exactly what that scope is. And what I mean by that is a blizzard a severe weather event? Well, it would be in Texas, maybe it's not in Buffalo. Or is snow just a severe weather event? And if snow, the 2 inches of snow in Buffalo collapses your roof, is that something that you would want to capture, even though 2 inches of snow is not all that severe, relatively speaking, in the history of Buffalo? So it does provide for a lot of judgment. It allows for companies to come up with a definition that you are required to provide context for the assumptions that you make and for basically how you've considered and how you've defined it, and to apply that consistently from period to period. I do think there's an element that it might evolve to the extent you have competitors who look at it differently. I've had some discussions with companies who said, well, maybe we'll use sort of the declaration of a national emergency or the state declaration as a threshold for whether it's severe or not. That bar seems a little bit high to us, given that basically a declaration requires the governor to make an appeal to the federal government for resources that it can't handle on its own. And that seems like a bit of a high bar. So it does allow companies to provide a little bit more judgment in determining what's in the disclosure. But as I said, I think the key is about transparency and about consistency.
Thanks. And I think another sort of definitional question that was raised in the Q&A was around materiality and defining the materiality of climate and how best to do that. And are there insights and tools to help them with that? Steven, any insights?
Yeah, so this is something that the Supreme Court has ruled on and has been discussed many times, because again, for a company, they don't have to submit, I'll take every receipt. They have millions of receipts. It's just what's material to think about in terms of the public audited statements. So the Supreme Court has said, and this is not the exact quote, so don't use the words, but it's what a reasonable investor would want to know in making purchasing and selling decisions and or in their shareholder actions. So it depends on the industry, exactly as Valerie said, same as weather. I mean, if you're a tech company or a professional services company, the impact on weather it could be a lot different versus a manufacturing company. So there's differences in location, there's differences in your supply chain. Is your supply chain, locked up in the Panama Canal or some other place? So it really depends on your company, your corporation, where your employees are, where your company, where your customers are, your suppliers are. And materiality is something that, again, there is a lot of case law written about this.
Thank you. Just looking up in here on the question. So let's turn to a question around scope 3. So as you've both mentioned, that was taken out of the final rule due to a lot of pushback and I think concerns about litigation, but also that it's a challenging thing to do technically right now, et cetera. What do you think the opportunity is for that to be included in the future? Do you think companies should be beginning to get a hold of their scope 3 emissions anyway, because it's in other regs, right? So what are your thoughts on this whole question around scope 3 and what will be happening, both the SEC, but what companies should be pursuing? Valerie, do you want to?
Yeah, I think it unlikely at this juncture. I feel like the scope 3 was a bit of the third rail from an SEC standpoint, although the SEC as a commission voted 3-2 across party lines in favor of adopting the rules. But even Commissioner Carolyn Crenshaw, who was one of the supporters of the rule, actually expressed disappointment that it didn't go far enough. She actually wanted scope 3 to be included. I think also what Steve mentioned is relative to the political environment, depending on the election next year, could determine how the SEC looks at and evaluates an expansion of disclosure. But in the meantime, I would expect that most SEC registrants are also subject to the California rules, which do require scope 3. So while I don't know that the SEC has it on their plan to expand the disclosures, California clearly has it within their scope. And if you're not captured by California, which is currently law, similar laws have been raised in New York State, in Illinois. We've heard rumors in Massachusetts and Washington State. So there is sort of a critical mass growing that would require the scope 3 emissions to be disclosed under other frameworks, in which case companies would be ill-advised to put their head in the sand relative to trying to calculate what those were.
Thank you. We had a couple questions actually about the SEC rule versus the California rule. Could you share with us a little more detail on the California rule in terms of how it differs, but also how it relates to what is happening in Europe as well, just to give us that more granular context?
Sure. Oh, sorry, go ahead,
if you want to
Valerie.
start, Steve.
Sure, I'm happy to. So again, there are two laws in California, but together, one focuses on really using TCFD as a basis. One focuses on greenhouse gas protocol as a basis. So one looks at the greenhouse gas does include scope 3. Again, it's public and private companies, and it's estimated, we're doing a detailed study now, but there are about 10,000 companies, probably about a third or a little more that are public, and the balance are private. Again, they could be based anywhere in the country, or even they could be based abroad if they have a U.S. subsidiary. That California also there's a court challenge to that, and they're just starting the regulation. So while the SEC has finished their regulatory review, the California laws are written, but now their regulatory agency, CARB, California Resources Board, they'll be starting soon. They need additional budget to start those. One of the things that is not in the California is in the SEC is substituted compliance. The question is, if you do one, will that cover? While 90% of it will be the same, or maybe even more, that the SEC said they didn't have enough information yet because California hadn't been implemented, CSRD hadn't been implemented, so they didn't feel comfortable doing a replace, that if you've done one, you can do it. So it's essentially, you can use the same material, but you can't just submit it now. That's something that could be revisited in the future. And again, the California laws, we think are, they're broader in the ways that I talked about, and there are some other details too.
Valerie, anything to add?
Yeah, I think there's also a third California law that doesn't get as much press, referred to as Senate Bill 1305, that actually requires disclosures relative to the making of claims. So companies who make claims about emission reductions, about their products being carbon neutral, or about achieving net zero. So that also captures some of the additional disclosures that the SEC would require. That also requires disclosures about the use of carbon offsets and RECs, so carbon offsets that are purchased or marketed or sold in the state of California. So that will also enhance it. Relative to Europe, when you look at the ESRS, or the European Sustainability Reporting Standards, because, as Steve said, the Senate Bill 261 requires compliance with the TCFD recommendations that we've spoken about. We think that those are probably comparable to a lot of the disclosures you would be required if you applied what's referred to as ESRS E1, or the climate regulation within Europe. As you may know, they go much broader. It's not just climate in the European standards. They address biodiversity and workforce and social and governance elements. But I do think there's a lot of information that can be leveraged. Now, the California law on emissions requires strict compliance with the greenhouse gas protocol. If you use another method for your SEC reporting, you may need to make modifications to comply with the SEC, but those CARB regulations may allow some flexibility there. From a TCFD standpoint, it specifically identifies compliance with the International Sustainability Standards Board standards, that if you have a report that is subject to the ISSB standards that actually can be used to satisfy your TCFD requirement in California. So everyone seems to be focused on this idea of interoperability, but definitely agree with Steve that the SEC decided not to address equivalency or interoperability in the adopting release, one of the 886 pages. They mentioned that they really want to wait and see to the extent that you see the disclosures that are provided in response to the international frameworks to see whether they're sort of fit for purpose for the SEC.
An interesting point sort of raised here in a question by one of the audience members is that as companies are required to report into CSRD or into the California regs or voluntary standards by investors or others, they are going to be setting these, they're going to be doing this analysis, et cetera, which will now then make them subject to the SEC, even if they weren't initially, right? So all of this seems to be pointing towards, regardless of what happens, this is going to move forward in some form, as you'd said earlier. I had another question around brought up here, which was around litigation risk. So it says, when you discuss financial risk, you'll be invariably addressing litigation risk, could come from any stakeholder. What's your sense of the added litigation insurance costs firms will be facing as a result of this rule, potentially, or the other rules out there?
I know that I've never been asked that question. I know that I have a specific opinion on that. I think that there is always going to be litigation. The truth be told, the U.S. is a litigious environment to operate in. The disclosures are factual, they're transparent. There's a lot of context that needs to be provided about why you're making the disclosures and the basis for those disclosures. So I don't know how that would play out from an insurance or from a litigation standpoint.
I can briefly add that, I completely agree with Valerie in this piece. There's a separate analysis, professor at University of California, Davis, done an analysis of directors and officers insurance. And because directors are mentioned for the first time in detail, not as much detail as the draft, but in detail, that some people are saying there may be more questions about directors and officers insurance, but there's also a safe harbor built in, a protection, so that if people are doing work in good faith, which is what's going to happen, you're going to estimate X, and then a year later, 5 years later, there'll be better information. Just this as this, and as long as you do it in good faith, that's really the issue there. And again, from our perspective and lots of other people, this is not a gotcha thing. And it's important to know now. I mean, last year the SEC issued more fines on disclosures, including climate disclosures, than ever before. So this is not a quote. While there's some of the new provisions, this has been around for a while. I also just want to highlight that one of the questions had to do with products, that this is not at the product level, but there is a separate effort under the federal government supplier rules, that there's a draft rule that said if you're a large federal supplier, you'd have to do climate disclosure at a product level. So that's another initiative that hasn't been finalized yet, but it's ongoing.
Thank you.
And actually, sorry, maybe Tensie, on that point, on the federal regulations, there's also a proposal that could be finalized this year for federal contractors, that the question that was asked about whether you have to disclose a target if you have it versus requiring a target, major federal contractors, and those are with contract awards in excess of $50 million. And that's a contract award value versus an individual year or revenue basis. But federal contractors would be required to disclose not only their scope 1, 2, and 3 emissions, but to produce a target and have it verified by the Science Based Target Initiative, which would look to compliance with the Paris Accord and the attempt to limit global warming to 1.5 degrees. So there is a portion of companies who deal with the federal government who would be required to have that target.
Thank you. Very helpful. So I want to go back to the point, Stephen, you raised earlier, which was around board of directors insurance. That this has got a significant focus on the board. As you know, I've done a fair amount of research around ESG credentials of board members, looked at this back in 2018. At that point, out of 1,188 board members, only a handful had climate credentials. And when we look today, I haven't released this formally yet, But we see now that that number has increased from, I think it was around 8 to 22, but that's still out of around 1,200 board members. And when I look at it by industry, I find that, for example, in energy, very few experts around climate in the energy sector or in a variety of other sectors that have significant, like transport, that have significant climate risk implications. The one interesting thing that I did find, by the way, is that back in 2018, only around 20 companies had ESG committees, and today it's close to 90. So there's a real shift in terms of board governance focus on this on ESG in general. So I'm sort of more pontificating here than asking you a question, but I am getting to it, which is how you mentioned earlier, Valerie, that the idea here was that board members just needed to get the experts to help train them. But in fact, if you don't know the questions to ask, you can't use climate experts well, right? So how would you recommend, the two of you, that companies tackle this in terms of their board understanding of these issues? How do they train and support them? Do you think it's actually good practice to potentially bring onto the board somebody who has more specific expertise? Or if they don't, how can they get that expertise?
I think some of the concerns with the original proposal, and I referred to it in my sort of presentation, was that make or buy decision, that you cannot have a board that covers every possible risk to the company. And I think companies looked at this relative to last year's cybersecurity rules, which originally were worded similarly about identifying whether a board member had cybersecurity expertise, and was modified such that the cyber rules and the climate rules now match, meaning that they're responsible for oversight, but you're no longer required to state whether you have that expertise resident within your board directors. So I think that companies can look at it in any number of ways. There is still a requirement to disclose whether management has that expertise. So I think that there needs to be that collaboration, coordination, and communication between management and the board relative to explaining the nature of risks, how they've been addressed, no different than any other unique risks that may come up within a company. I think that some boards will choose to engage with outside experts in order to evaluate climate-related risk, and I think that that is still a judgment given to boards. Now, from a CSRD standpoint, they do add the existing requirements about the responsibilities of audit committees to oversee financial risk. They have now added financial and sustainability disclosures and reporting. So there is a specific mention of these requirements having to be within the board itself from an international standpoint. But domestically, for US boards looking over the US disclosures relative to the SEC, I think that there's any number of ways that a company could accomplish that to feel confident that they have executed their sort of fiduciary responsibilities.
Thank you. Steven, anything you want to add?
Briefly, Tensie, first, thank you for your research. It is groundbreaking. It's so important, and updating it. We have a lot of resources additional on the Ceres website. But fundamentally, think of if you replace the word climate with major risk, of course the board needs that expertise. They need it at the board level, they need it at a committee level. There's no one structure for a committee. In some places it could be in the audit committee, it could be in a sustainability committee, but it covers across the board. It affects personnel, capital planning. It needs to be in senior management. We think it should be as part of executive compensation. So it's important that these issues get addressed at the board level, both the risk and the opportunity that climate presents.
Thank you. Question from an investor perspective, focusing on the disclosure of impact materiality CSRD, any thoughts about how companies in the financial services industry are going to be able to assess and disclose the impact of all investments on their books and records and on their AUM? For large institutions, they have AUM invested in almost every company in the world. How should the industry begin to think about this?
So we've recommended, and the largest banks, for example, have started to do net zero plans, and they do them by sector. So first they'll say, okay, let me look at the loan portfolio in the oil industry, and then the cement and transportation, and look at those areas. And just recently, last week or so, Citi announced that only 42% of their clients had a detailed net zero plan. So they need to look at that. There's been a lot of studies now, including an article just got published last week, that shows the financial institutions, the banks, have more risk on their balance sheet because of climate today than in '08 because of subprime housing. So SEC is a good step, but the companies need to go further.
Good. All right. Well, I know we're getting at time here and we've got a lot more questions, so I apologize. I guess quickly, Valerie, any final thoughts of words of advice for the group? And then I'm going to turn to Steven to ask you the same and also ask you to talk a little bit about freedom to invest. So Valerie.
No, I think that it really starts with that understanding of what the requirements are, doing that comparison to the information that's currently being disclosed and doing your own gap analysis in advance of the timeline. And as we mentioned, relative to the litigation status is sort of continuing full force in making sure that you're prepared to the extent that the regulations are enacted as written.
Great. Thank you. Steven, your final thoughts here.
First, thank you and to Stern and you and everyone for this opportunity. So three things. If you're a company, think of it as a ladder. Wherever step you're at, go to the next step. If you haven't started scope 1, do scope 1. If you haven't started scope 2, so get ready for the next, because the regulators are going to ask for it and also your investors. Second is, if you're supportive of this, speak out in whatever way is appropriate for you, because there's a lot of controversy even now. And then third is Freedom to Invest is an initiative we started. You can go to freedomtoinvest.org, because there's a lot of this anti-ESG stuff, both at the state and federal level. And we think companies and investors should be free to think about risks and opportunities and not restricted artificially.
Thank you so much. Well, I really appreciate you providing all this fascinating background on what is a really existential issue for all of us. And we look forward to seeing how things pan out in the years to come. And hopefully our audience has learned a great deal from the both of you, as I have. So thank you again for taking the time to talk with us.
Thank you.
Thank you, everyone. Enjoyed having you here today.